Welcome back to Brave Ideas. I'm your host, Caleb Parker, recording again live all season long from New York City, Juicy's 50th edition. One of the biggest shifts happening in office real estate right now isn't on the supply side. It's actually happening on the demand side. Enterprise occupiers are thinking differently about flexibility. What started as a short-term solution or overflow strategy has evolved into something much bigger. Flex is increasingly becoming a core part of a corporate real estate portfolio, and that's changing everything. It's changing how operators compete, it's changing how landlords evaluate opportunities, and it's changing how deals get done. Joining me today are Christine Wyckoff and Justin Halpern from Cushman Wakefield. Together, they sit at the center of many of these conversations shaping enterprise flex across North America. In this episode, we discussed how enterprise customers are using flex today, why speed to market has become such a powerful advantage, how hybrid leases and management agreements are reshaping the industry, why operators increasingly need to pitch landlords like investors, and what separates successful flex brands from everyone else. This is one of the most practical conversations of the season for anyone involved in growth, deal making, or landlord partnership. Without further ado, let's head into it. Christine, Justin, welcome to Brave Ideas.
Thanks for having me.
Thank you so much. Very exciting to see you in person.
I know, it's the first time. Can you believe that?
First time we've crossed paths in person ever.
Christine, we had a overlap in our careers, though, way back in the day.
I know. Do we start naming names and dating ourselves? No, I don't think so. But we could, because it's just too small of a world in this sector. So
it's one of the cool things about coming to these conferences. Like we're at Juicy today for the 50th here at J Suites in Manhattan.
Yeah.
Got a little audience here.
Yeah.
But one of the cool things I like about coming to these conferences is seeing people you see online that you may not have ever met in person.
I agree.
And so
I agree.
Here we are.
I ran into someone that I actually trained at Regis when he first started. And I said to him, I was like, how are your kids doing? He's like, well, the youngest is 21, Christine. And then I just walked away. I said, I'm done. I don't want to hear it anymore. It's that long.
Coincidentally, he's now leading sales for a group that I transacted for back in 2023.
And then the circle becomes full again.
Well, you mentioned 2023, but I noticed you didn't date yourself on the...
Hell no.
Okay.
Hell no.
I'm guessing this was a few jobs post when you worked with them.
Yeah, I don't know how, I'm not going to answer that. I'm not going to plead the fifth on that. Honestly, everyone knows my story. I got my job in the industry literally on monster.com. 2 weeks, I started 2 weeks after 9/11.
Oh, wow.
So that's when I started at HQ Global Workplaces, when it was a different product.
Well, I got my job through IWG when it was Regis, through Monster.com as well.
Imagine.
Not to make this an advertisement for Monster.com.
I don't even think they exist anymore, right?
Do they?
But I don't think so.
I don't know,
know.
but I would venture to guess that people are leaning towards Indeed versus Monster.
Yeah, but that's how it was a fluke of events. That's how it started.
Well, we should probably jump into the topic of the day. And as I said a moment ago, apologies I don't have some whiskey to offer you, but we've got sweet tea, water, and iced coffee. Yeah. So, all right, let's kick it off. Look, we've had this conversation prior to today about enterprise demand. It's changing the flex market. It's been around for a long time, but the nature of that demand is changing. It's changing how operators need to present themselves when they're pitching landlords. There's more pitching going on because as we move from lease arbitrage to management agreements and in between. So to unpack that, I want to jump in and I'll start with you, Christine, if we can. When you're speaking to your corporate flex office customers, what are they actually using flex for? How are they looking at flex and how is it different today than it used to be?
So it's a great question. And I think the fundamentals have not changed since I first started in the industry, but the buy-in has evolved over time. So there's always been that conversation. How can we integrate flexibility into our portfolio, save money, bring people into the office, and create an environment that feels like our space? I think what's changed today versus having done it to, recruiters and headhunters, like in small businesses, 25 years ago, is that institutional buyers are now thinking about it as fully integrated into their portfolio and really looking and trading, if it's 5,000 square feet or less, which is a benchmark number that's been in the industry for decades, but really saying 5,000 square feet or less with utilization data saying that, we're not coming into the office every day. We're hybrid. why aren't we in a space that has 10 desks for 30 people and saving all this money? Oh, and by the way, moving in tomorrow. So I think that has, that conversation has evolved, and it's now being executed more rapidly than it was in the past. So I think the fundamentals and the basics are the same, but the execution is now there.
So Christine, when a customer is looking at an enterprise flex offer in a market and they're comparing different options, when they see that list of options in that particular market, what is it that says this doesn't work and that's perfect for me?
Flex versus a sublet or traditional space. I think that's what I see the most comparisons to. I think it is in many times still a cost transaction. What is the most cost effective for the largest amount of space for something that could be culturally fitting our organization? And I think speed to market, which you can't really put a number on, is something else that, again, basic, but still part of the fundamentals of this sector of co-working, of flex, whatever you want to call it, that speed to market is the key to this sector, that no one can do what we do. And no one can also offer space with 100% utilization all of the time. So that's how I see when you run the numbers side by side, a sublet space in a market where there's not a lot of space available, or a co-working space for groups of 50 or more, the numbers are not really that much different. So then it becomes a cultural buy. Like, would this work for our company? Is the value proposition of the provider enough? If you've lost the deal, I don't believe you're really losing on price to another brand. You're losing it onto your different value proposition. And what is it? And have you communicated that during the tour, during the sales cycle, and to the end users as they tour the space? A lot of time the end users are not the decision makers, but they could break a deal. Maybe not make it, but they could definitely break a deal if they don't like the space. So I think, people are talking about excellent customer service. We overuse the word hospitality. I have mixed feelings about that. You've got it, or you think you've got it, but you really don't. And that's part of the value proposition of every brand, and making sure that is shown in the sales cycle for the enterprise. Because now everyone in this room will do an enterprise deal if they can find the right space or they have the space. But buying one over the other is really what's the selling features that would push someone over the line to one brand over another when there's one on the corner and one on this corner.
And does it enter the conversation, or do you get involved in the conversations when you've got an enterprise company looking for space, traditional space? I was here in New York in January, and we were in Tishman's studio, right? And they had an enterprise customer that took traditional office, but would only do the deal if the studio product was in the building, so they could have access to it. Are you seeing those conversations come up?
No.
You're not seeing those?
Yeah. So, I mean, that flips to kind of the landlord side of the equation. Mm-hmm. The corporate user, the case that you're referring to is a situation where, these big corporate users, the Fortune 100s, Fortune 50s, have a number of things that they're looking for in an asset that they want. Whether they're going to utilize them or not is kind of to be determined. But when they go to market, they want health and wellness, they want sustainability, they want fitness, they want food and beverage. Well, flex has now become part of that conversation. So if you have a larger asset, similar to Tishman's assets, having flex will give you, that leg up. It's not a must-have in a lot of cases, but it's a nice to have when you're looking at those scorecards and evaluating what assets you're going to go into, even if you're not going into the flex. One of the best examples of like a fully integrated asset would be what Vornado did at One Penn Plaza, which checks, medical, conferencing, lounge, food and beverage, flex, and that's servicing a 2 million square foot building.
And 1,000 square foot wide, big screen, right?
Right. That's right. And it's 80,000 square feet of flex on the second and third floors of that building that sits at 100% occupancy. So even if a corporate user that's in that building thought it would be nice because they'd be able to flex in and out as needed, from a practical standpoint, maybe not the case, but it might help that landlord win the deal.
So if that's the case, and enterprises looking at having flex as one of the amenity tick boxes in a building, then landlords it used to be that, landlords would sign leases with operators, and whoever could pay top
market rent.
Right.
Now it's like, okay, I'm getting really selective as a landlord on who I'm going to bring in and why. What are the landlords expecting from the operators today?
Each landlord is different. It depends on the ownership structure. You've got your publicly traded REITs, you've got family offices, you have closed-ended funds. So depending on that structure and the capital stack and what their priorities are, that's going to help them inform what type of operator they're going for. If the motivation is to bring in corporate users that want flex in the building, they're likely going to want a household name, because they're going to be able to sell that in a way where these corporate users are familiar with that operator. If it's, a family office or a closed-ended fund, it might be based on valuation. If it's a long-term holder, it's going to be, who do I think is the best operator to partner with to maximize returns? Returns are obviously important to all different types of ownership structures, but the more you know about the capital stack and the priorities of the landlord, the more an operator will be able to position themselves when going into that meeting to try to pitch their brand or their business as the right fit for a certain asset.
So 10 years ago, WeWork was signing deals left and right, paying over market rent. Landlords were eating it up. The agents and brokers were eating the commissions up.
Yep.
It was almost like, I've said this before, but it's almost like the end of the movie Scarface. And when Al Pacino's right there, he's got all the white powder, and everybody was hooked on the WeWork white powder at that stage. Since then, we've seen what's happened and how things have changed in a positive direction.
Yeah.
But it used to be that the lease arbitrage model was the way operators transacted.
Right.
Landlords preferred it. Now we see a lot of operators jumping on to management agreements. We've seen hybrid leases. We still see the lease arbitrage model, but there's a lot more barriers today to doing deals. What's the barriers to entry for that?
Yeah. So to your point, they were signing top of market leases, which really was completely counterintuitive to their landlord partners. The landlords wanted as much rent as humanly possible, to contribute as little capital as humanly possible to avoid risk. Yet you were setting up your future tenant to fail, because the higher the rent, the lower the probability of success, et cetera. So the reset of the industry went to a place where, you needed interests to be aligned, really. These are partnerships. So, I've transacted, I don't know, probably 15 deals over the past 24 months with flex providers, the majority of which are hybrid leases. There's a face rent that's underwritable by the capital markets. And then there's a revenue share above that where the landlord and the tenant are both participating. The interesting thing about where this has become is when you enter that room, it has nothing to do with finding space. It's easy to find space depending on the market, in a decent building, in a decent location. It's about finding the right landlord partner. The way that a lot of the success is happening is approaching these deals as if you're going in to pitch your VC. These people are investing in your business. They're along for the ride. They're going to benefit from your success. So your broker is almost your investment banker. It's not an arm's length transaction. It's selling landlords on the value proposition versus negotiating against them. Of course, there's a negotiation on the TI, on the free rent, on the percentages that are shared in that deal. But the approach is very different than finding space in the right location and negotiating a deal.
Well, going back to what you said earlier, it depends on the landlord themselves on what deal they're looking for.
Right.
What their business plan is, and whether they're a large fund or an individual, or what are the nuances there?
Yeah, I mean, you have to get creative. Every deal is different. I mean, the capital stack on the building is hugely important. One of the scenarios I mentioned was a closed-ended fund. They might actually need the ability at some future point in time to convert that variable rent to fixed rent. The capital markets are catching up. They are starting to give some consideration to the variable rent, but they can't do that until there's an operating history. So if there's an event within the first, call it 3 years of operation, whether that's, a loan maturity, a sale of the building, or some other issue, an equity raise, et cetera, it's very difficult to get these deals done.
Hey, everybody, I'm breaking into the podcast. My name is Liz Elam. I'm the founder of Juicy, and I wanted to break in and let you know that there's other ways to be connected to Juicy. So you can join Juicy membership if you go to juicy.co, which is gcuc.co. On membership, you can find a really great deal right now. We're running a summer series, and in July, we're in the middle of it, and our second speaker is going to be on at the end of July. So definitely look at joining membership, which is also a great way to get discounts to Juicy events in live, in person, in real life, which is where we all want to be right now, is in real life. That is the future. In September, we're going to be in beautiful Cape Town, Africa, doing Juicy Africa for the first time. Antoinette is working really hard on that event. Head over to africa.juicy.co for more information and to get your tickets. Then in October, we're back in London, which is always such a great event. London is such an amazing city. It's so vibrant. The scene is incredible. You should definitely consider attending. You can get information there on uk.juicy.co. Emily is working her tail off, and it's going to be epic as always. And if that wasn't enough, we recently announced that Juicy USA 2027 is in one of my favorite cities in America, the vibrant, the amazing Miami. Early birds are up. They're never going to be this cheap again. So also look at juicy.co for a link to Miami early bird tickets. That's the only place you'll find those tickets. Anyway, we're over here busy thinking of new and exciting ways to educate you guys and inspire you guys. Hope you're enjoying the podcast. We had such a great time at Juicy's 50th with Caleb and Brave, and now I'm going to turn you back to it.
So if I'm an operator thinking I want to go scale my brand, I shouldn't go just knock on every landlord's door.
No, and I can tell you, I see the flip. So at Cushman Wakefield, we do asset management. So there's all these assets that are under our purview that are being called on by flex providers to say, hey, I see you have empty space. Why are you not monetizing it with co-working or flex? And we're going to come in. So it's funny, like Justin and I sometimes run parallel, and then we bump into each other, and then we run parallel again, because I'll get tapped in by our asset team that says, well, Christine, what do we do with this? Yes, we have this empty space, but what's the story? Like, what is this? Because there is still a faction of the marketplace that this is still new, right? I mean, because it represents 3% of the overall real estate in the universe is co-working / flex. It's well known, but not as well known as we think. A lot of what I see is helping a landlord dissect the brand that's best for them and why. And what I see from that chair is that kind of going back to your value proposition as the provider and pitching it to the landlord and understanding the landlord's, the building goals, the asset goals, who they are holistically. Have they been burned by another brand? That's come up a lot of times. But where I've seen the people who have lost out in the cases that I've seen, it's because their story wasn't compelling enough for the landlord to choose them. And it really wasn't about, yes, there's the whole economic piece of it, but they are really the ones who are looking to do this. They're looking for the right partner. And they're looking for that energy that comes from the co-working sector, and not just like, you got lucky with a cold call, because that also happens. And I talked to an institutional landlord the other day, and they're like, yeah, we have so-and-so in Boston, but like they're calling us for like this obscure property like 20 miles outside of Raleigh that has, why are they doing that? So it does, you have to be intentional about everything you do, especially with the landlords, because I believe you've got really one shot. And that's it.
You've got the alignment between the brand and the values and the community and the customer you're serving, and enterprise is a piece of that. But then, most landlords, aren't they just looking at, the numbers and, not just the rent numbers, but the balance sheet of the operator, the covenant strength, their track record.
Yeah. So that's part of the investment banking VC pitch approach to your meetings with landlords. They want to know who's behind the company financially and operationally. Who are the individuals? What have they done in the past? What is their track record? What's the differentiator of your product? Are you one of many? Are you niche? Are you focused on a specific subsegment of the marketplace? There's one in San Francisco right now that's focused specifically on climate tech, and it's they actually curate their occupancy. How do you substantiate your underwriting? If you're a new market entrant, where are you getting your assumptions? Where is your data coming from?
So where should it come from?
Well, ideally it's historic and it's real. If you can point to, here are our 5 most recent, not just successes, most recent launches, and this was our ramp period, and this is what we're achieving on a per seat basis. Here's our pricing power. Here's what we've done to the asset. We're doing these other things, community engagement. I mean, that's, there's a couple different pieces of this. There's what you're doing within the 4 walls, which is your co-working, your hospitality, your activation. And then what does it do for the rest of the asset? And what other value does it add to the landlord? So we had a situation anecdotally recently where the landlord was losing their anchor tenant. It was a roughly 500,000 square foot asset, and they were losing 300,000 square feet of tenancy. So this was an inflection point. This was a repositioning. We approached them and said, you're going to do the lobby. You're thinking about amenities. You're going to reposition this building and go through a leasing program. We think it would be very beneficial to bring life back to the asset and to activate it in a small way with flex and get bodies coming through the lobby, walking through the turnstiles. And we took a 25,000 square foot slug of space, which in the context of a 300,000 square foot vacancy isn't that much. So the risk was fairly low. Obviously, they were focused on the returns that square footage would bring them, but they were more focused on the fact that they thought it would help them raise rental rates elsewhere in the asset and increase leasing velocity. It was part of the story.
And so when they're looking at the ROI on presumably the TIs they're going to give to that flex operator, are they factoring in the rental increase as well as the return they're getting on that?
I don't know if it's changing the underwriting necessarily on the other space. I think it's more of a reactivation and a leasing velocity piece.
So it's a bit art and science.
Yeah.
So the science piece, they're saying, here's how much I'm making on this TI from the income, but this art is, here's how we're going to increase prices.
Think about this conversation. You own a building, and I walk in and sit down with you and say, I want to pay you half of market rent, and I want you to give me 40% above market in TI. What do you think? What does your lender think? And I'm telling you, I'm going to give you returns that are proportionately above market. If you have historic data, easier sell. If there are other value adds, easier sell. If it's a conversation in a vacuum, very different.
And the pro forma piece of it, that's the first thing that we pull apart on the asset side, is looking at the pro formas that come in with no data behind it, no reasoning behind it, and a price point that isn't in line with the market. So how can you? It's a quick eyeball. Right away. You don't even have to deep dive into the numbers to know that the math doesn't math. I think that's like from where I sit. It's part of the. It's a sales problem. It's a sales problem
from the operator pitching the landlord.
From the operator pitching the landlord.
Anybody can back into a profitable underwriting. I mean, I can put it to ChatGPT and ask it to give me cash flows for a co-working facility that'll show my operating expenses, unit level operating expenses, my price per seat. Like that's easy to do. But if the data can't be defended, which is what makes it really hard for new market entrants. Another, what I would consider a mistake, and I guess this is biased and personal opinion, but a lot of people come to market specifically here in New York, and they ask brokers to show them space, and it's multiple brokers, and they're going and touring things. It's a sales process. It's not run a market survey, go see 5 things, put in 5 proposals. it's a sniper approach versus a shotgun.
But can I clarify something then? Are these pitching management agreements and partnerships? Or are these you're having to pitch to get a lease? You're the client pitching to get a lease.
The way of the industry is going to the hybrid lease and the match.
Never thought I'd see the day when landlords would prefer a management agreement or hybrid
I don't
versus
know
a lease.
if they would prefer or not, but arm's length leasing transaction with a SPE and a fairly new entity, they're not going to get credit from the capital markets for that anyway. They won't be able to refi against it. It won't positively affect building valuation necessarily. So
I just want to make that clear because I think a lot of us think that, well, if we've got some money in the bank and we can go sign a lease and it's easy peasy.
Yeah. Are you going to prepay 3 years rent? Who knows?
Who wants to do that?
There's a lot, right. There's a lot of levers that can be pulled. I mean, the other thing that is very common is there's very little instant gratification. These deals take a long time and they typically die 1, 2, 3 times before they get done. It's a slog and takes, avoiding deal fatigue and being super creative because you're running into roadblocks and you need to pivot and do it a lot.
And you've got all these companies coming in from Europe who's saying we've successfully taken over locations, blah, blah, blah. And now we want to repeat it in the US. It doesn't necessarily work, but they're coming. So you've got, all the American brands trying to expand in a partnership way and being thoughtful. And then you've got all these other companies just coming in and I see, because those are the calls that I'll get, Christine, I need a broker. In what 10 markets does Cushman recommend that we should open a co-working location? Oh, and by the way, we're not in the US. We don't want to put any money down. And we have like these odd specs. And I'm thinking to myself, I wish you the best, but we won't take that type of business.
One thing that, you mentioned the quote unquote competitor takeover. There's been disruption in the space now that the space has become more mature, and those competitor takeovers are easier ways to enter a market because there's less capital. And then the counter argument of it that a lot of landlords used to make was, if I have a traditional tenant, a tech tenant that's in open plan workspace with a couple conference rooms and a pantry, and I get that back, I have residual value. And they used to say co-working was very specific. There was no residual value. Now people are seeing residual value in those installations. So while the risk is still there, because there is a track record and deals you can point to of successful takeovers and new entrants coming in, operating, turning on the lights and being successful, that argument has quieted down a little bit.
Yeah, because I think there's a lot of second gen space that's been taken over recently that sounds to be successful, continues to be successful, has some stories behind it. So I think we have it and we have it out there. But I think I see such an aggressive, rapid pace of those trying to do these types of deals that are missing the fundamentals of, like, I'll put on like a sales hat. Like, where's your sales leader helping you as the individual? Like, you're dialing for dollars through CoStar to try to get in touch with people. It doesn't make sense, and it only makes the entire sector a little salty, right? Like and landlords saying, "Well, this guy called me, that guy called me." I don't want to talk to anybody when really it's the right asset for a co-working space. So I have so many different purviews on it because of who I touch and why. It's fun to be in my shoes, but it's a little, sometimes I get frustrated. I'm like, let's just get the story straight, get your value proposition straight. And I'm not here to pitch brokers, but get the right person to represent you, to have these dialogues with a landlord, because you really only have like 1 or 2 shots. And it's got to be folks who are like in market, seasoned. And I know a lot of companies try to do it themselves, but I'm a believer that in-market support is a game changer for
I was involved in previous life in some of these second-gen takeovers, and I'm not a fan of them personally. And although someone bit my ear recently and it's made me have a different perspective a little bit, but I always felt like a second-gen space, if I'm trying to build a brand, And my customers are going to think, oh, this is just a WeWork space with a different name. But those have been successful, making a few aesthetic changes. So I was just talking to an operator in the UK. Their whole business model is targeting these second-gen spaces and putting a layer of aesthetic on top of it so it looks different, but saves massively on the capex and it returns cash to their investors faster. So maybe that is right.
There's definitely a space for it. It's happening real time. And it's in many cases path of least resistance if you're trying to enter a new market, get a foothold. But to your point, are you really building your brand? Are you differentiating yourself in what's become somewhat of a crowded space? It didn't used to be as crowded, but there's a lot of new market entrants, whether it's new, just organic, or new to a specific geography. So, you're towing that line of how badly do I want to get into the market and how quickly, or, do I want to be super intentional as I do it?
So for those that want to be super intentional, you mentioned earlier in the last 24 months, you've been involved in 15 transactions. On the operator side, help the operator pitch and win the deal with the landlord, whatever that deal looked like. So can we get in maybe under the hood as much as we can to what worked and what can people take away from that?
It's a lot of what we discussed. It's you have to be very succinct, very intentional with what your value proposition is. You need your deck and your presentation. It's not about touring a space and sending a proposal. You want to get a meeting. You want to sit down, if you can, principal to principal, and show those landlords who you are as a person, as a business, etc. We painted a picture of like conservative landlords and mitigate risk. That's obviously a major segment of the market. There are also really entrepreneurial landlords out there that want exposure to this space. They want to do it with the right partner, and they view this as investing in a business. I would go back to just getting as smart as humanly possible before going into that meeting on the composition of the asset, what the priorities of the landlord are, the ownership structure, what barriers might be there, so that when they ask those questions, you're super quick to have an answer or, a rebuttal, for lack of a better way to.
So would you say that sort of before the whole pitch takes place, the mindset needs to be a consultant coming in, asking lots of questions first to understand that landlord, what their structure looks like, their business plan?
Yes.
And knowing 100%. Who you are. I think in the brands who are successful, knowing who they are, who their members are, how they're attracting members, what members in what market, and the data behind that. So there's so many new things with AI. There's so many great things happening in the co-working sector. I'm waiting to see the data come from that, so that the conversation says, hey, Mr. Landlord, I did this in Atlanta. Here's the type of clients and members that that come to my brand. Here's what other services they use. And by the way, your asset is right in the middle of all of those things. Let's have a conversation. So I haven't heard those types of approaches. So maybe that's just, I'm not privy to them, but that would be something a little bit more compelling as we start to collect more data from the co-working sector.
Slightly different question. So in this transaction, it's taking forever. It dies a couple of times. When you think you're about to win it and then it dies, what causes that?
9 times out of 10, it's the capital and the lack of credit and securitization. And then
But wouldn't they know that up front?
They do, but for whatever reason, a lot of landlords will take the journey with you, and then when it gets to decision-making time, get cold feet. The other thing that tends to happen is there are typically layers. There's an asset manager, there's an analyst, there are all these people. So the deal is progressing, but it hasn't gotten to the decision-making level, and they'll bring it back to, in the case of, listen, there's the families in New York, there's the Runes, the Dursts, the Moynions, and they're all different priorities, etc. It doesn't necessarily get to those family members when the first conversation happens. It starts with the broker. and then it involves an asset manager. So you're kind of going down that road, and you could think that everyone's rowing in the same direction, and all of a sudden it's not. So, the quicker you can push on that and make sure that the right stakeholders. I've had situations where a deal is fully negotiated and a lease is even executed, and it goes for lender approval. The lender has 10 days to approve or deny, and the deal gets declined.
How much resource has been invested in that process? So frustrating.
A lot.
Mm-hmm.
Legal, time, human capital.
But there's also the wins. Do you think the market is going to move in a direction where you're going to have a lot of smaller operators that get really good at niching down to, like you mentioned, the climate tech earlier? Or do you think it's going to be more and more of scaling operators that can support enterprise when it comes to doing better deals with landlords?
In tertiary markets, that niche providers will be the winners. And if they can capture that market and really understand it, that sector will grow. But I do think on the institutional side here, we've got all these big major brands. That's their go-to-market strategy. So, and they've done it, they've proven it. That will continue to grow. But my hope is that as this universe has evolved, that these smaller providers continue to expand, come up with unique value propositions that I can't even imagine, that attract end users to a space because you're always competing with your home office, not each other.
What do you think? I mean, will the corporate user pick a niche local operator?
They do.
They do.
If you talk about global business, it goes to the top global brands. But in local markets, I see names of companies I've never heard of that we're doing business with. It leads me to believe there are great local providers who are opening businesses up that however they're doing the deals, they're winning, Fortune 500 companies.
And my last trick question for you, Justin, is just macro, New York, the economy the way it is today, the uncertainty that's out there. Are we going to see a lot more flex transactions with landlords?
Flex is proven. There's demand. It's a good business that can deliver good returns and other value to landlords. So I think we will see it. Landlords want it. Tenants want it. It's become part of the larger ecosystem. I can speak most authoritatively to New York. The demand is super high. The well-located operators in good assets are doing really well. And, if things continue, knock on marble, wood, whatever this is, we'll continue to see transaction velocity. At a certain point, you have to assume there is saturation, but I don't think we're there yet.
There we go. Good way to end it. Thank you both very much. Great to see you in person for the first time. Great to meet you as well. Thank you for tuning in. And until next time, take care of yourself.